You thought money was the missing piece. You believed funding would change everything. But here's the brutal reality. Most traders who get funded don't lose because of the market, they lose because of themselves. Pressure crushes them. Rules trap them. Ego destroys them. And in a matter of days, the opportunity they prayed for disappears. Most traders carry one dangerous belief quietly in their minds: if they just had more capital, everything would change. They imagine that profitability is locked behind a bigger account size, that consistency is simply waiting on the other side of funding. This belief feels comforting because it shifts responsibility away from personal behavior. It suggests the problem is external. The account is too small. The leverage is too limited. The opportunity is restricted. In that story, the trader is capable, but underfunded. The reality is far less comfortable. More capital does not create discipline. It does not create patience. It does not create emotional control. It amplifies what already exists. If someone is impulsive with a small account, they will be impulsive with a large one. If they overtrade with $500, they will overtrade with $50,000. The size changes, but the behavior pattern remains. In fact, the larger the account, the faster those patterns produce damage. Funding does not repair weaknesses. It exposes them under brighter light. Small accounts often hide flaws because the consequences feel manageable. Losses seem temporary. Mistakes feel recoverable. A trader might think they are aggressive because they need to be, or that they take excessive trades because the account is small and needs to grow. When funding arrives, those same habits do not disappear. They scale. The trader who once risked 10% on a small account now feels tempted to risk aggressively on a larger one. The trader who revenge traded to recover a minor loss now feels the emotional urge multiplied because the numbers are larger. Pressure intensifies behavior. Passing a funding challenge adds another layer of illusion. Many traders complete challenges through short bursts of aggression. They increase risk. They overleverage during strong trends. They capitalize on favorable market conditions. Sometimes luck plays a role. The goal becomes hitting the profit target as quickly as possible. The focus is narrow and short-term. When the challenge ends successfully, it creates a sense of validation. The trader feels proven. But keeping a funded account is a different psychological environment. The rules feel heavier. Daily drawdown limits become real constraints. Maximum loss limits feel threatening. Consistency requirements add pressure. Instead of pushing to hit a target quickly, the trader must now protect capital day after day. Aggression that worked during the challenge becomes dangerous. What was rewarded before is now punished. The mindset required shifts from attack to restraint. Restraint is uncomfortable for many traders because it demands patience in moments when action feels easier. It requires letting trades go. It requires accepting small gains without chasing larger ones. It requires stopping for the day after hitting a loss limit instead of trying to recover. Most collapses happen not because traders lack technical knowledge, but because they cannot tolerate the emotional discomfort of holding back. There is also a subtle psychological shock when the capital feels real. When trading on demo or with a small personal account, the emotional intensity is lower. The trader may feel relaxed. Losses feel theoretical. Decisions feel less threatening. Once funded, the emotional weight increases. Heart rate rises during open trades. Every tick seems significant. The screen holds more power. The mind becomes hyper-focused on fluctuations. Under that pressure, behaviors change. Stops are moved because the loss feels painful. Profits are closed early because fear of giving back gains becomes stronger. Losing positions are held longer because admitting the loss feels heavier. Some traders double down to recover quickly, convincing themselves that a single strong trade will fix everything. The market itself has not changed. The charts look the same. The strategy rules remain identical. What changed is the internal state of the trader. That internal shift is where many funded accounts quietly disappear. Traders who believed funding would fix their inconsistency discover that inconsistency feels amplified. Emotional reactions become sharper. Discipline feels harder to maintain. The structure of the funded account exposes every weakness that was previously manageable. Ego plays another powerful role. Getting funded feels like a milestone. It feels like validation. The trader begins to see themselves differently. They may think they are now part of a smaller elite group. Confidence increases, but sometimes that confidence drifts into overconfidence. The internal narrative changes from cautious execution to self-assured dominance. With ego inflation comes subtle rule bending. Risk is increased slightly because the trader feels more capable. A low-quality setup is taken because confidence suggests it will work. A daily limit is stretched because the trader believes they can recover. The discipline that was tight during the challenge becomes relaxed. The funded account turns into a trophy, something to display internally as proof of skill. Trophies, however, are fragile when not supported by consistent behavior. The irony is that funding is not a reward for being perfect. It is a magnifying glass placed over a trader's psychology. It reveals emotional stability or instability. It reveals whether patience is real or forced. It reveals whether risk management is a habit or just a temporary strategy used to pass an evaluation. The numbers on the screen simply make those traits more visible. Many traders search endlessly for better indicators, refined strategies, or secret techniques, believing that profitability depends on superior market analysis. While strategy matters, most failures do not originate from a lack of technical knowledge. They originate from emotional reactions under pressure. The inability to stop after hitting a daily limit. The inability to accept a small loss without escalating risk. The inability to sit out a market that does not meet criteria. Funding does not repair those issues. It intensifies them. The trader who never developed emotional control feels the gap more clearly. The trader who never practiced consistent risk management feels exposed. The trader who never separated identity from outcomes feels the pressure deeply. In reality, capital is neutral. It does not transform character. It does not grant discipline. It does not guarantee maturity. It simply increases the consequences of existing behavior. A disciplined trader with a small account will likely remain disciplined with a large one because the behavior is internalized. An impulsive trader will likely remain impulsive because the root pattern was never addressed. The painful truth is that profitability is rarely blocked by account size. It is blocked by psychological readiness. More money cannot compensate for emotional instability. Larger numbers cannot compensate for lack of structure. The market does not reward hope or ego. It rewards consistency, patience, and controlled risk over long periods. When traders understand that funding is exposure rather than salvation, their perspective shifts. Instead of chasing larger capital as the solution, they begin to examine behavior. They begin to ask whether their discipline would survive increased pressure. They begin to question whether their risk management is truly mechanical or emotionally flexible. They begin to see that the real work happens internally, long before capital increases. The illusion of capital is powerful because it offers an easy answer. It suggests that once the account is big enough, success will follow naturally. But capital is not the cure, it is the test. It does not build the foundation. It stands on top of it and reveals whether it was strong all along. After passing a funding challenge, many traders experience a powerful surge of confidence. It feels like validation of skill, proof that they belong among serious market participants. The internal dialogue shifts from doubt to certainty. They begin to believe they have figured it out. This emotional high can be dangerous because confidence without structure slowly transforms into recklessness. The trader starts increasing lot sizes slightly beyond what was used during the challenge. Patience begins to shrink. Confirmation signals that once felt necessary now feel optional. Risk rules that were strictly followed during evaluation are bent under the belief that experience will compensate. The market does not care about recent success. It responds only to execution. When structure weakens, punishment often arrives quickly. One of the most common reasons funded accounts disappear is the breaking of daily loss limits. Funded programs usually operate under strict risk parameters. A 5% daily loss cap, a 10% overall drawdown limit. These numbers are clear and mechanical, but emotions are not. All it takes is one unstable trading day. One morning where focus is off. One revenge trade placed after a loss. One oversized position taken with the intention of recovering faster. The account can vanish not because the strategy suddenly stopped working, but because discipline broke under pressure. The tragedy is that many of these accounts could have survived if the trader had simply stopped for the day. The rule was designed for protection, yet the urge to continue feels stronger in the moment than the logic of preservation. Revenge trading intensifies this problem. When a funded trader hits -2 or 3%, Panic begins to build internally. The mind starts calculating how far they are from the daily limit. Fear mixes with urgency. Instead of stepping away, they feel compelled to fix the damage immediately. The next trade is no longer about executing a valid setup. It becomes about emotional recovery. The size might increase slightly. The entry might be rushed. The stop might be widened. Revenge trading is emotional gambling disguised as strategic adjustment. It feels justified because the trader convinces themselves they are simply trying to get back to neutral. Funded firms do not tolerate emotional spirals. They enforce numbers, not intentions. Another silent killer is overtrading in the name of maximizing opportunity. Funded traders often feel pressure to extract as much profit as possible from the account. They believe that since capital has been granted, it must be utilized fully. This mindset pushes them to take trades that barely meet criteria. Low-quality setups become acceptable because they are technically within the strategy. Multiple sessions are traded in a single day, even when energy levels drop. Entries are forced during choppy conditions. Fatigue is ignored. The trader confuses activity with productivity. The real objective is not to place the highest number of trades. The objective is to maintain the highest level of discipline. Overtrading slowly erodes focus, and reduced focus increases mistakes. Fear, surprisingly, destroys more funded accounts than greed. Once traders understand how easily the account can be lost, anxiety creeps in. Every open trade feels heavier. Instead of letting winners reach planned targets, profits are closed early to secure something. Stops are moved to break-even too quickly out of fear of loss, resulting in premature exits before the trade has room to develop. Valid setups are skipped because hesitation whispers that this might be the losing one that ends everything. Fear does not create dramatic collapses immediately. It slowly bleeds consistency. The equity curve becomes uneven not because the system is flawed, but because execution is distorted by anxiety. A major weakness among funded traders is the absence of a structured business plan. Many have a trading strategy with entry and exit rules, but very few operate with a comprehensive framework. They cannot clearly define their weekly loss cap beyond the firm's maximum. They do not know how many trades per day is optimal for their focus level. They have not identified specific market conditions they should avoid. They are unclear about maximum risk per trade relative to both daily and overall limits. Without structure, decisions become emotional and situational. Structure acts as a boundary that prevents escalation. When that boundary is missing, behavior becomes reactive. The difference between having a strategy and having a business plan is subtle but critical. A strategy tells you when to enter and exit. A business plan tells you when to stop trading altogether. It defines acceptable drawdowns before stepping back. It outlines recovery protocols. It accounts for psychological state, not just chart patterns. Funded traders who ignore this layer operate on technical skill alone. When emotions spike, there is no predefined response. They improvise under stress, and improvisation under pressure often leads to poor judgment. Another overlooked factor is the lack of an emotional recovery system. Professional traders understand that losses are inevitable. What separates them is how they reset. They step away from the screen. They review objectively. They allow emotional intensity to decline before re-engaging. Most funded traders do the opposite. After a losing trade, they stare at charts for hours trying to analyze what went wrong in real time. They obsess over missed opportunities. They replay the loss repeatedly in their minds. Instead of detaching, they immerse themselves deeper into the source of stress. Mental fatigue compounds quickly in this state. Decision quality declines. Reaction time slows. Emotional sensitivity increases. A small additional loss feels catastrophic because the mind is already overloaded. The trader believes they are working harder to recover, but in reality they are draining the mental clarity required for disciplined execution. Without a defined reset process, the spiral continues until a rule is broken or a limit is hit. There is also a hidden pressure unique to funded trading. The trader knows the opportunity is conditional. It can be revoked instantly if rules are violated. This awareness creates a background tension even on calm days. The desire to prove worthiness pushes some traders to trade more than necessary. They feel they must demonstrate consistent profitability immediately. Instead of allowing results to accumulate naturally, they attempt to accelerate validation. That urgency subtly shifts risk perception and increases impulsivity. Small deviations accumulate, slightly larger lot sizes, slightly earlier entries, slightly wider stops. Each decision alone seems insignificant. Combined, they create vulnerability. The funded account does not usually disappear because of a single catastrophic idea. It erodes through repeated emotional decisions layered over time. Eventually, one of those decisions collides with a losing streak, and the protective limits are breached. Consistency requires emotional neutrality, yet funded environments amplify emotion. Numbers are larger. Consequences are immediate. Identity becomes attached to performance. When identity fuses with results, losses feel personal rather than statistical. Traders then defend their ego through risk escalation or denial. They hold trades longer than planned because closing would confirm error. They re-enter quickly because missing a move feels like incompetence. The market becomes a battlefield of self-worth rather than a probability game. Another issue is the illusion that passing the challenge means mastery. In reality, it often means the trader aligned with favorable conditions for a limited period. Markets change. Volatility shifts. Trends end. Without adaptability grounded in discipline, the same aggression that worked before becomes destructive. Traders who do not recalibrate continue applying the same intensity regardless of context. Many funded traders underestimate how important boredom tolerance is. There are days when no high-quality setups appear. Professional discipline means accepting inactivity. Impulsive traders interpret inactivity as missed opportunity. They manufacture trades to avoid feeling unproductive. This behavior gradually increases exposure to random outcomes. The account becomes vulnerable not because the trader lacks intelligence, but because they cannot sit still. Risk management rules exist to protect traders from themselves. When those rules are viewed as obstacles rather than safeguards, resistance forms. The trader begins negotiating internally. Just one more trade. Just a slightly larger size. Just today. These negotiations rarely end well. Discipline is strongest before emotion rises. Once emotional intensity takes over, rationalization becomes easy. The core pattern across these failures is not technical incompetence. It is psychological instability under constraint. Funded accounts impose boundaries. Those boundaries expose how well a trader can operate within limits. Some thrive under structure. Others feel confined and react impulsively. The difference determines survival. Blowing a funded account rarely feels like a single mistake in the moment. It feels like a series of justified decisions. Each step seems reasonable when viewed in isolation. Only afterward does the pattern become obvious. Overconfidence, broken limits, revenge trades, overtrading, fear-driven exits, lack of structure, and absence of emotional reset mechanisms intertwine. The market simply responds to execution quality. When execution deteriorates under pressure, consequences follow with precision and indifference. Pressure changes the way the mind functions. In calm conditions, decision-making is slower, more analytical, and more balanced. A trader can review structure, confirm signals, and execute with clarity. When money begins to feel real and consequences feel immediate, the internal state shifts. Stress activates survival mechanisms inside the brain. Instead of long-term evaluation, the focus narrows to immediate protection. The body responds as if there is danger. Heart rate increases. Breathing becomes shallow. Attention locks onto short-term fluctuations. In that state, rational thinking weakens. Survival mode is not designed for probability-based decision-making. It is designed for quick reactions. That reactionary state leads to impulsiveness. Trades are entered early because waiting feels risky. Positions are closed prematurely because securing something feels safer than trusting the plan. Stops are widened because accepting loss feels threatening. Short-term thinking overrides long-term consistency. The trader is no longer executing a system. They are reacting to discomfort. Funded trading demands calm logic under exactly these conditions. It requires the ability to think clearly while numbers fluctuate. It requires the ability to accept temporary loss without emotional escalation. Most traders never trained this skill deliberately. They studied patterns, indicators, and market structure, but rarely trained emotional regulation under pressure. When stress arrives, their technical knowledge becomes harder to access because emotional noise dominates. Another internal battle begins with identity. Many traders attach their sense of self to outcomes. A winning day becomes proof of talent. A losing day becomes evidence of inadequacy. This fragile identity structure creates extreme emotional swings. When results are positive, confidence inflates rapidly. When results are negative, self-doubt intensifies just as quickly. Funded trading magnifies this pattern because the stakes feel larger. The account is not just capital, it becomes a symbol of achievement. When identity merges with performance, objectivity disappears. A losing trade is no longer a statistical event within a probability system. It becomes personal. The trader feels attacked or exposed. Instead of analyzing execution calmly, they defend their ego. They might hold on to a losing position to avoid admitting error. They might re-enter quickly to prove they were right. They might increase size on the next trade to restore self-image. Emotional attachment to outcomes quietly distorts behavior. This identity crisis creates instability. Confidence should be rooted in process, not in single outcomes. When identity is built on daily profit and loss, emotional volatility becomes unavoidable. Funded environments amplify this because traders feel they have something to protect. The account represents validation. Losing it feels like losing status. That perception intensifies reactions and clouds judgment. Scarcity thinking adds another layer of psychological pressure. Many funded traders believe opportunities are rare and fragile. They tell themselves this chance may not come again. That belief generates urgency. Urgency compresses decision-making time. Instead of waiting for ideal conditions, they rush to participate. Instead of allowing trades to develop, they interfere prematurely. Scarcity thinking narrows perspective to the present moment and exaggerates its importance. Professionals approach markets differently. They operate from abundance thinking. They understand that markets produce opportunities continuously. Missing one trade does not threaten long-term success. There will always be another setup. This belief creates patience. It allows them to step away after losses without panic. It allows them to skip unclear conditions without fear of missing out. Amateurs often feel that each trade carries enormous weight. Professionals see each trade as one small event within thousands. Scarcity also encourages overexposure. When traders believe they must maximize every opportunity, they increase frequency and size. They attempt to extract as much as possible from each session. This urgency reduces selectivity. Selectivity is one of the strongest forms of discipline. Without it, exposure increases and randomness grows. The trader becomes more vulnerable, not because of poor analysis, but because of psychological pressure to act. There is also a biological component to the trading battlefield. Trading stimulates dopamine release in the brain. Winning produces a surge of reward chemicals. Fast market movement creates excitement. High volatility generates stimulation. Even anticipation of a trade can produce a chemical response. Over time, some traders unconsciously begin to chase this stimulation. They trade not only for profit, but for emotional intensity. This dopamine cycle can become addictive. After a strong winning day, the mind craves repetition of that feeling. When markets are slow or conditions are calm, boredom sets in. Boredom feels uncomfortable compared to the stimulation of active trading. To escape boredom, traders may create activity. They enter marginal setups. They scalp unnecessarily. They monitor charts obsessively searching for movement. The behavior is driven less by strategy and more by the desire for excitement. Consistency, however, often requires boredom tolerance. The most stable funded traders are not adrenaline seekers. They are routine-driven operators. They accept that many days will be slow. They accept that some sessions will produce no trades. They find satisfaction in disciplined execution rather than emotional highs. Their reward system shifts from excitement to stability. This shift reduces impulsive behavior and protects capital over time. The psychological battlefield is not fought against the market. It is fought internally between impulse and restraint. The market simply provides the environment. Within that environment, stress, identity, scarcity, and dopamine interact. Without awareness, these forces guide decisions automatically. With training and structure, they can be managed. Emotional discipline becomes more important than technical complexity. It is possible to give 100 traders the same profitable strategy and observe drastically different results. Some will follow rules consistently. Others will deviate under pressure. The difference lies not in knowledge, but in execution quality during emotional moments. Knowledge operates best in calm states. Execution must operate in volatile states. Under pressure, small deviations compound. A slightly early entry increases drawdown probability. A slightly delayed exit reduces reward. A slightly larger position increases emotional intensity. Each small emotional decision affects the next one. When discipline weakens, the probability edge embedded in the strategy erodes. Traders often blame the system when results decline, but the real cause is inconsistent execution under stress. Training emotional control requires intentional practice. It requires observing reactions without immediately acting on them. It requires stepping away after losses, even when the urge to recover feels strong. It requires redefining success as rule adherence rather than daily profit. Without this training, pressure will dictate behavior. The brain under stress seeks certainty and immediate relief. Trading offers neither. Markets are uncertain and outcomes are delayed. This mismatch creates discomfort. Impulsive trades provide temporary relief because action feels like control. Waiting feels like vulnerability. The ability to remain inactive when conditions are unclear is a skill developed through repetition and self-awareness. Funded trading intensifies every psychological weakness because the consequences are clear and measurable. Daily limits enforce boundaries. Drawdowns highlight mistakes. There is little room for emotional fluctuation. Traders who lack emotional regulation experience amplified stress cycles. Traders who cultivate calmness maintain clarity even when numbers move against them. The battlefield remains invisible to outsiders. On the surface, it appears to be charts and data. Internally, it is a constant negotiation between logic and emotion. Survival in funded environments depends less on finding perfect entries and more on managing internal reactions. The strategy provides structure, but emotional discipline determines whether that structure is respected when it matters most. The shift from problem to solution begins with one uncomfortable adjustment. After getting funded, most traders feel the urge to increase risk. They believe this is the moment to capitalize. The smarter approach is the opposite. Risk should be reduced immediately after funding. The first objective is not rapid profit. It is survival. A funded account is an opportunity, not a lottery ticket. Protecting it in the early phase builds psychological stability. When risk is smaller, emotional intensity drops. Decisions become clearer. Surviving the first weeks creates momentum and confidence rooted in control rather than aggression. Scaling can always come later. Lost capital rarely returns as easily. Creating a strict daily shutdown rule is another protective layer. Emotional damage often happens within a single undisciplined session. Predefined limits remove negotiation. Stopping after 2 consecutive losses prevents revenge spirals. Locking in the day after reaching a planned reward protects profits from overconfidence. Limiting the total number of trades per session preserves mental energy. These constraints act as guardrails. Professionals operate within boundaries because they understand that freedom without structure leads to inconsistency. Amateurs rely on feelings in the moment, and feelings fluctuate with every tick. Shifting focus from payout to process changes everything internally. When attention is fixed on the payout, urgency increases. Every setup feels like it must work. Every missed move feels costly. That pressure encourages forced entries and emotional exits. When focus shifts to executing the process correctly, patience improves. The goal becomes following rules precisely rather than extracting maximum profit. Consistency in process builds stable results over time. Obsession with payout distorts judgment and increases stress. A trader who measures success by discipline rather than money maintains clarity longer. Setting a personal weekly risk cap below the firm's maximum limit strengthens longevity. If the firm allows a 10% drawdown, voluntarily restricting exposure to 5% creates a margin of safety. This self-imposed boundary reduces the probability of catastrophic weeks. It also reduces psychological pressure because there is more room to operate calmly. Self-restriction is not weakness. It is strategic conservation. Longevity in funded trading depends more on avoiding large losses than on chasing large gains. Smaller drawdowns are easier to recover from and less damaging to confidence. Developing a structured post-loss reset routine prevents emotional stacking. After a loss, especially a frustrating one, the mind seeks immediate correction. That impulse must be interrupted deliberately. Stepping away from the screen for a short period lowers physiological stress. Writing down what happened clarifies whether the loss followed the plan or resulted from deviation. Reconfirming entry criteria and risk parameters restores structure. Slow breathing stabilizes the nervous system. This routine transforms loss from emotional trigger into learning event. Without a reset, frustration accumulates and spills into the next trade. Trading less than instinct suggests is a powerful advantage. Many traders believe more activity equals more opportunity. In reality, excessive activity reduces clarity. Selectivity improves performance because it filters out mediocre conditions. Fewer trades mean more attention per trade. Stress decreases when exposure is limited. The mind remains sharper when it is not constantly reacting to new positions. High-quality setups produce better outcomes over time than constant participation. Discipline in waiting is often more valuable than precision in timing. Detaching emotionally from the account changes behavior at a fundamental level. Viewing the capital as money under management rather than personal possession reduces impulsive risk-taking. When traders see the account as a responsibility rather than a prize, protection becomes natural. Emotional ownership encourages gambling because the account feels like an extension of ego. Professional detachment encourages measured decisions because the focus shifts to stewardship. Managing capital requires respect for rules, patience in execution, and acceptance of controlled risk. That mindset supports stability under pressure and encourages consistent behavior aligned with long-term survival. Transformation into a consistently funded trader begins with a shift in mindset. The first step is to stop trying to be a hero. Many traders chase big days because they feel impressive, because a large win feeds ego, excitement, and validation. That desire for immediate recognition often drives risk beyond what is sustainable. Big wins can feel like proof of skill, but the same impulses that chase those wins often ignore limits, widen stops, and override rules. One impulsive session can erase weeks of disciplined progress. Funded trading is not about spectacular moments. It is about steady, controlled weeks that accumulate into long-term success. Preserving the account takes priority over impressing oneself or others. Redefining success is equally critical. Most traders equate success with passing a funding challenge, getting a funded account, or hitting a large payout. These are short-term milestones, often misleading. Real success is measured in longevity, keeping a funded account for 6 months or more without violating rules or risking catastrophic drawdowns. Long-term preservation outweighs the thrill of temporary wins. Treating each session as part of a cumulative process instead of a single performance contest changes how trades are approached. Longevity requires humility, patience, and discipline. It requires valuing the compounding effect of small, consistent actions over flashy results. Building emotional tolerance is another cornerstone of identity transformation. Funded trading is, above all, an exercise in emotional endurance. Traders must learn to sit through small drawdowns without panic, accept missed trades without frustration, and endure slow or uneventful market days without forcing activity. Boredom is a feature, not a bug. Emotional stability comes from accepting discomfort rather than reacting to it. This requires deliberate practice, stepping back when trades are missed, observing the market without action, and maintaining calm during minor losses. Those who master tolerance protect their accounts from impulsive decisions fueled by stress, fear, or greed. Thinking like a risk manager rather than a trader is another defining shift. Amateur traders often ask themselves, "How much can I make today?" Their focus is on reward rather than protection, which breeds urgency and reckless behavior. Professional traders ask, "How do I protect my capital?" This subtle difference creates freedom. Capital preservation removes the pressure of needing immediate results and allows traders to wait for high-quality setups. Risk-conscious thinking ensures that trades are entered under favorable conditions and exited according to rules, not emotions. Protecting the account consistently ultimately produces opportunity for growth, whereas greed-driven decisions often lead to rapid losses. The final truth is that most traders do not fail funded accounts because they lack technical strategy. The technical system is secondary to execution. The true causes of failure lie in missing emotional structure, inadequate risk control, impatience, and unstable identity. Funding does not change who you are. It does not instill discipline, patience, or calm. It reveals your current state. The moment real capital is at risk, your emotional strengths and weaknesses are magnified. To survive, a trader must become someone capable of handling pressure, managing risk, and remaining consistent despite fluctuations and setbacks. It is the internal transformation, not the strategy itself, that determines longevity in funded trading. Success in funded trading is therefore not measured by wins, profits, or challenges past, but by the ability to maintain control, protect capital, and execute with discipline over time. Those who achieve this operate from a place of emotional stability, patience, and risk awareness, which allows them to endure the psychological pressures that destroy the majority. Becoming part of that 5% requires deliberate, sustained effort to shift identity, mindset, and behavior toward preservation, restraint, and consistent execution.